Hi there, I welcome you to my revision session. Now in this session, we are going to look at relevant costs and short-term decisions. Of course, I will discuss some of the principles of decision making, most especially the concept of relevant cost. We are going to see what relevant costs are, and then how would we apply the concept of relevant costing when it comes to making short-term decisions. This is your tutor, Senior Hannington. Don't forget to subscribe to my YouTube channel. Don't forget to share. Don't forget to like. Don't forget to subscribe. So this is a past paper question which I expect you to get. This should be on your table. That is June 2023, paper 10. We go straight to question 4. Let's move straight to question 4 because that's our area of concentration today. What are we required to do? First of all, first look at the requirements of the question. We are required to advise the council of UGS on whether to approve the proposed dividend payout for the year 2023. Then advise them on the components of the decision-making environment. Then advise them on the management accountant's role in the decision-making process, making it 20 marks. Now, advising the council on UGS on whether to approve the proposed dividend payout for the year 2023-2024. Let's go back to the start of the question and see from the start. UGS, located in Uganda, is a higher research-based academic institution that offers only specialized PhD courses in the areas of international relations, tourism, environmental, health, and sports sciences. The candidates are instructed through a hybrid arrangement involving physical and online engagements. UGS operates an academic year ending 30th June. Okay. The shareholders are forecast to individual payout of shilling 2,400 per share. Yet the council prefers earnings retention so as to develop the university to one of the best global PhD awarding institutions in the region. UGS has 500,000 paid up shares at a nominal value of shillings 10,000. So you see now we have different stakeholders. We have the shareholders as well as the university council. So their interests are conflicting. The shareholders prefer a dividend payout of shilling 2,400. So for them, they prefer getting dividends at the end of the academic year. They need some dividends. When you do the math, 2,400 shillings per share, they have 500,000 shares. That is a dividend payout of 1.2 billion. But the council is like, no, for us we prefer earnings retention. Remember, the earnings retention is after the dividends have been paid. Okay. The BASA on that note decided to examine cost minimization strategies without compromising the university activities. She informed the council that shareholders can have a dividend payout for the academic year with the help of management accounting techniques. The council promised to support her strategies if she delivers a retention ratio of 20% to take care of the decision-making environment. So the council is like, okay, we are going to support you if you come up with the strategies, as long as at the end of the academic year, you deliver a retention ratio of 20%. Remember, the retention ratio is that is getting your retained earnings over the net savings times 100%. So the council is like, we need a retention ratio of 20% to take care of the decision-making environment. Now, below is the information extract from the proposed budget for the academic year 2023-2024 before proposing the cost minimization strategies. Now, the BASA has some management accounting techniques which he or she wants to apply such that they minimize on the costs, and if costs are minimized, that the shareholders can have their dividend payout. Okay, but now the council is like, okay, we are going to support you, but as long as you deliver a retention ratio of 20%. So this is the proposed budget for the academic year before proposing the cost minimization strategies. Academic staff salaries, support staff, medical expenses, NSF employer contribution, staff welfare, estate maintenance costs. That is what we have in the original proposed budget. But now the BASA is like, okay, as part of the senior management staff, all other staff functions should be outsourced. So now the BASA is coming up with his proposals. Okay, so all other staff functions should be outsourced. She also proposed downsizing the rented space to maintain only the administration complex, whose purchase council has already approved at 3.0 billion. The payment to the owner is expected to be made in December 2023. The academic staff are going to be engaged on an hourly rate during the academic year 2023-2024. A professor, associate professor, and senior lecturer will be paid shillings 500,000, shillings 450,000, and then 300,000 per hour, engaged respectively. The PhD candidates will need 5,820 hours, 3,360 hours, and 6,240 hours of engagement with the professors, associate professors, and senior lecturers respectively during the academic year. Now, Smart Brains is ready to provide all the qualifying support staff at an annual bill of that. This will save all the annual estate maintenance costs. So meaning that some costs will be avoided. So the company will make some savings. Those are incremental benefits, as we are going to see. Both academic and support staff will be paid termination benefits amounting to 4% of their annual salaries. Senior management staff consumes 20% and 10% of the medical expenses and staff welfare respectively. The agreement with the landlord for the class sales complex requires a 3-month vacation notice, which will be served in July 2023, that the building will be vacated in September 2023. It has also a clause for increasing rent by 8% at the beginning of each academic year. The current rental fees amounting to shillings that per month. The budgeted internet cost will also increase by shillings that for the year 2023-2024. So when you try to look at all this information, you'll have to understand the concept of relevant costs. In decision making, only those costs that are relevant are always considered in management decision making. A relevant cost is that cost that will be affected by the decision being taken. When you try to look at this scenario, you'll see that there is a proposed original budget. However, the BASA is like, no, if we apply some management accounting techniques, the cost minimization strategies, some of these costs will go down. Others may increase, but others will go down. So, because of the differences in the cost that will be incurred, as a result of applying those management accounting techniques to minimize costs, you'll see that there will be what we call differential costs, or what we call incremental costs. The Chartered Institute of Management Accountants, CIMA, defines a differential or an incremental cost as the difference in total cost between alternatives calculated to assist decision making. You'll see the differential or the incremental costs in this scenario. You're going to come up with those costs. But don't forget that there can also be what we call incremental benefits or incremental revenues. Now, matching the incremental costs against the incremental revenues or savings will produce a figure for the incremental gain or loss between the alternatives, and we shall base on those figures to come up with our advice at the end of the day. Of course, it's a bit tricky question with one decision option. By the decision option is approving, whether to approve the board, is to advise the University Council on whether they should approve the proposed dividend payout. That is our decision option. Of course, you'll have to show all your workings, because this will earn you more marks. You have to show all your workings in this case. Let me take you straight to my working page. Then we see how we can come up with our solution. So my heading is relevant cost analysis relating to the proposed dividend payout. I can say for the year 2023-2024. So that's what we have. I have different 3 columns here: the original proposal, the revised proposal, then the differences in incremental costs and revenues, as we are going to see. The amounts are in shillings. I can show this level of rounding off, so I can maintain the same. Can maintain the same level of rounding off, and then we start. So the first thing you'll do, you'll have to first copy and paste all the details in the original proposal before the cost minimization strategies. Now, according to the question, this is what you have in the original proposed budget. So you have to copy all these items one by one with their amounts, then you paste them in this worksheet. Now this is I'm using this to show you how you can present your information. Okay, so we have academic staff salaries. We have been told in the question that according to the original budget, according to the original proposal, this is 6,060,000. Then we have support staff salaries, that this is 4,440,000. Then we have the medical expenses. This is 526,000. 526,000. Please get the question paper it should be on your table such that we move together. NSSF employer contribution for both academic. Okay, let me just say NSF employer contributions. This has been given as 1,050,000. We have the staff welfare. 850 to 600. Then the estate maintenance costs given as 585,900. Now that's what we have as per the proposed budget. That's what we have. However, the university bursar has some proposals as well. It's telling us that just want to look at the extra costs that are going to be incurred. Both academic and support staff will be paid termination benefits amounting to 4% of their annual salaries. So we have to look at these termination benefits. We have to incorporate them in our analysis. Then the agreement with the landlord for the classes complex requires a 3-month vacation notice, which will be served in July 2020, that the building will be vacated in September. So we also have to incorporate in the rent for the classes complex. Then I'm seeing the internet costs as well, which we can also include in our analysis. So we have the termination benefits, we have the rent, for classes complex, we have the internet costs, which should also be considered. Then of course I'll have to show my total costs stroke savings. Yeah, total cost stroke savings. Total cost stroke savings. In the original proposal, we don't have these, so these are all zeros in the original proposal. But of course I'll have to come up with the total costs as per the original. Where is my question paper? Okay, in the question paper we don't have the total, but there we are. That is our original proposal as per the question. That's what we have. However, the bursar has a revised proposal. We have to find out the results of the revised proposal after applying some of the management accounting techniques to minimize the costs. So when you try to look at the question, the bursar proposed that apart from the senior management staff, all other staff functions should be outsourced. Okay, the academic staff are going to be engaged on an hourly rate during the academic year. A professor, associate professor, and senior lecturer will be paid at that per hour engaged respectively. Then they give you the number of hours for each and every staff during the academic year. So we need to come up with some workings. Need some workings here. So these are my workings. So the figures here in shillings are thousands, okay? So these are my workings. First working, we have to find out the academic staff salaries. Academic staff salaries. So I have the hours, the rate, okay, and the amount. So this is what we have. Remember, I told you have to show all your workings because this will earn you some extra marks. You have to show all the workings. So we have the professors, we have the associate professors, and then the senior lecturers. Try to look at the hours. Senior lecturers, we have 6 to 40 hours during the academic year. The associate professors, 360 hours. And then the professors, 5, 8, 20. This is in the question, please. Then we have the rates. So for the rates, I'll put 500 for the professors because that's what we have in the question. Then for the associate professors, there is a 450. Then for the senior lecturers, we have 300,000 per hour. Remember, the 3 zeros are up. So to get the amounts, I'll just multiply. Then we come up with that. Then what is the total? Our total salaries for the academic staff. We have 6 millions. That is 6,294 millions.
SB18.
That's what we have. That's what we have. So these are the salaries that the university will incur, okay, on all the academic staff following the proposals of the university bursar. So I'll copy this figure from my workings, then I paste it to this column of the revised proposals. Now when you try to look at these two columns, the original proposal and the revised proposal, you will see that here the company is going to incur more on academic staff salaries. The company is going to incur more on the academic staff salaries. Okay, the company will income more on the academic staff salaries, meaning that there will be what we call an incremental cost. There is what we call an incremental. There is what we call an incremental cost. That incremental cost is 234,000. It's a cost to the company which is going to be incurred if they are to make the proposed dividend payout a success. Okay, so remember our decision option is approving the proposed dividend payout, but the university bursars come up with cost minimization strategies, and these minimization strategies will help us to either to advise management on whether to approve the proposed dividend payout or not. So the 234,000 is an incremental cost, and this is a relevant cost. Okay, if we want to approve the proposed dividend payout, then this cost is as a result of that option. We look at the support staff salaries. The support staff salaries. Let us see what the BASA is telling us. The BASA is like SmartBrains is ready to provide all the qualifying support staff at an annual bill of 4.89. Remember, I told them that the qualifying support staff we are going to outsource. And SBL is ready to provide all the qualifying support staff at an annual bill of 4.89. Let's take that to our working paper. This is 489,000. When you try to look at this, still the university is incurring costs. There is an incremental cost of how much? There is an incremental cost of 450,000. There is an incremental cost of 450,000 or 450 millions. We move to the medical expenses. According to the original proposal, the university was incurring 526 millions. But according to the university BASA, is like for the medical expenses, senior management staff consume 20% and 10% of the medical expenses and staff welfare, respectively. So we have to calculate the staff welfare as well as the medical expenses. Medical expenses, that is 20%. That is 20% of what? Of what they have been incurring originally. Okay. So medical expenses. That these medical expenses, that is 20% times what they have been incurring times what is in the original, that is 526,500. Remember, my amounts are in shillings and thousands, and that gives us 105,300 or 1,105,300,000. So we bring that here. Now, in this case, there is a saving. The university is going to save. They are incurring less. The costs have been minimized when trying to look at the medical expenses before and then after the revision. The cost has been minimized. So this is an incremental benefit. That is an incremental benefit of 420,700. That is an incremental benefit. Okay. By the way, in the original question, medical expenses, it is 526,500. It's a 500. Okay, then NSSF employer contributions. NSSF employer contributions. Now, the NSSF employer contributions, due to the fact that we are outsourcing, then of course the university will save. The university will make a saving for this. So the incremental benefit, this is a saving, members, is 1,050,000. That is a saving. Then for the staff welfare, the university bursar is like, okay, the staff welfare, that is 10%. Senior management staff consumes 10% of the staff welfare. Okay. Let us calculate our staff welfare. Staff welfare. Staff welfare, that is 10%. This because 10% times 852,600, which gives us 852,60. So staff welfare have 852. Still, the university is making a saving on the staff welfare following the implementation of the cost minimization strategies of the university bursar. So we have 767340. That is a saving. Of course, it's a relevant benefit to this decision. Then the estate maintenance costs, we are told that the university will save. This will save all the annual estate maintenance costs. So the maintenance costs are 0 following the revised proposal. And so this is a saving. It's a relevant benefit from following the revised proposal. So we have that. Then the termination benefits. Initially we had no termination benefits, but it's like the university will have to pay some termination benefits. Both academic and support staff will be paid termination benefits amounting to 4% of their annual salaries. Okay. So let us look at the termination benefits. Termination benefits. So when it comes to the termination benefits, there is academic staff, as well as the support staff. As well as the support staff. So 4% of their annual salaries. Those are the salaries in the original proposal. This was 6,060,000. That is 242,400. Then for the support staff, 4% times giving us 177,600. What's the total? Our total is 420. Of course, now this is still a relevant cost. This is an incremental cost. Okay, it's an incremental cost. The difference, total cost between the alternatives, original proposal, revised proposal. So that is an extra cost, a relevant cost for this decision. Then rent for complex. Let me first put the internet costs. No calculation on the costs. That is 40.25. 40. That is 42.50. Of course, this is also a relevant cost. And the incremental cost is that. Now for the rent for classes complex, you can compute this. Rent for class complex. Now this rent, remember there was a vacation notice, okay, that the university will have to leave the premises within 3 months. The academic year is starting from July, so they are giving them a period of 3 months. So, and when you try to look at the agreement, that rent will be increased, or rent was to be increased by 8% at the beginning of the academic year. The time period is 3 months from July to September. So what you do, originally rent per month was how much? It was 24,750. 24,750. Of course, that is per month, so times 3. But of course, there is an increment of 8% at the beginning of each academic year. So I'll multiply by 1.08 to account for the increase, and this gives us 8190. So that is our rent. That is our rent. Of course, that is a differential cost because in the original proposal there is a 0. The revised proposal there is 8190. So this is a relevant cost. It's an extra cost that is incurred as a result of this particular decision. So that's what we have. Now let us get the totals. Let us try to look at the totals. Costs have reduced completely, by the way. When you try to look at this, the costs are all reduced. So that's what we have. That's what we have. So following the university bursars cost minimization strategies, we see that the university is saving 1.6, in fact it is 1.6 billions. These are savings. Okay, so let us see. Remember, there is a dividend payout. At the same time, there is a retention ratio target. So we have the differences. Okay, difference in favor of the revised proposals. Difference in favor of the revised proposals. That is 1.6 billions. That is 1.6 billions. Now let us try to see, out of this 1.6, there is a dividend payout. Okay, so we have dividends payout proposed, dividend payout proposed. We are told that the directors prefer a dividend payout of 400 a share. Remember, the university has 500,000 shares. In fact, let me leave out the 3 zeros up. That gives us 1.2. It's 1.2 billions, by the 3 zeros are up there. That is the dividends payout proposed. So out of the net savings we have of 1.6, this is supposed to be 500 because I'm leaving out the 3 zeros. That is 1.2. Yeah, it will be 1.2. That is our dividends payout proposed. So if you pay out those dividends, then of course the retained savings, okay, retained savings, that is our net savings minus the dividends proposed, that is 400,000. That is our retained savings or the retained earnings. What is our retention ratio? Let's look at the retention ratio. Retention ratio. Our retention ratio will equal to what? How would we compute the retention ratio? Of course, we have to get our retained earnings, so it is that over the net savings of 1.6. Then, okay, that gives us 25%, but I can express this as a percentage. And then we'll see what we have. Express that as a percentage. That is 25%. But remember, the University Council are sure to support the University Bursa if they deliver a retention ratio of 20%. But for the cost minimization strategies, the dividends payout proposed is met, and even the retention ratio of 20%, the target, is also exceeded. So I think the University Council should approve. The University Council should approve the proposed dividend payout. Okay, so you have to advise. So advise. You have to show advise. You can say that the analysis. Now this is your analysis. Okay, the analysis indicates that the Bursa's cost minimization strategies should be supported. Because they result in a 25% retention ratio. Okay, compared to the target, compared to the target of 20%. Therefore, we conclude, okay, therefore we conclude that the Council of UGS should approve the proposed dividend payout out for the year 2023. For the year 2023. For the year 2023, 2024, following the adoption of management accounting techniques as decided by the BASA. So they can go ahead and then approve the proposed dividend payout. Okay, but that will be after following the management accounting techniques as decided by the BASA. That will give rise to cost minimization. Components of the decision-making environment. Of course, now here you have to talk about the decision-making environment. We have certainty, where there is complete information available as to what is going to occur. So under that environment, it is always very easy to analyze the situation and make good decisions. In fact, the decision-making environment of certainty, the decision-making process is just picking the best alternative. Okay, so it is very simple to come up with to make a decision in such environment. But then, of course, there is also uncertainty, where more than one state of nature exists, but the decision maker lacks sufficient knowledge to allow him assign probabilities with the various states of nature. So here you cannot predict the statistical confidence of the different events because you have no data to rely on. And of course, when it comes to such environment, the decision making in this environment will depend on the risk attitude of the decision maker. Remember, a decision maker can be a risk averse, a risk seeker, or a risk or a risky neutral. Then still we can look at risks. When it comes to risks, another component of the decision making environment, here more than one state of nature exists and the decision maker has sufficient information to allow him come up with probabilities that can be attributed to each of these states of nature. So when it comes to that environment of risk, situations or events may not or may occur, but of course the probabilities of occurrences can be statistically calculated. Okay, so you have to talk about those decision-making environments. Then the management accountant's role in the decision-making process. Management accountants play crucial roles in the decision-making processes within the organization, of course. They provide financial information, analysis, and insights that help managers to make informed decisions. But of course, they contribute to the decision-making process in different ways. First of all, they do what we call financial analysis. They play a role in cost management, a role in budgeting and planning, performance evaluation, strategic planning, decision making, and so on. So one thing you need to know is that management accountants are integral to the decision-making processes because they provide the financial expertise and insights that help managers make well-informed and financially sound decisions. That's it all for that question. In case you have questions, please feel free to put them in comments. Don't forget to share this video Don't forget to subscribe and don't forget to comment. I remain your tutor, Senior Hannington. Bye bye for now.